Here is something a lot of people do not understand. Investing is actually not as easy as it seems. It looks like over the long term, if you simply just wait for long enough, you buy stocks, for example, that the price will continue to creep up. You simply just buy the bottoms. But unfortunately, when we look at this risk adjusted, when we look at this inflation adjusted, when we look at this free from survivorship bias, then chances are that you're not making money, especially when you pick individual values, individual stocks, for example. Have a look at this chart starting in 1971. So that's more than 50 years of data. And what we've got over here is the S&P 500 divided by the money supply. So by US M2. If we look at how much did stocks actually rise, ignoring dividends, when ignoring fees, when ignoring taxes, then we went up by roughly 50% over the course of 50 years. And this is not the normal S&P 500 chart. This is S&P 500 divided by M2. So we have to adjust for this, right? As the money supply expands, as fiat inflates, the US dollar valuation of the S&P 500, of course, is going up. If there's suddenly double as many US dollars floating around, then of course, the value of stocks should also double on average. And so it's not that obvious that long-term stocks are a great bet. But this is only the US market, right? This is the US stock market, and the US stock market did quite well in the last 50 years. Let's look at all the other geographies. What we see over here is the Euro Stoxx 50 relative to the S&P 500 in US dollars. The chart starts in 2015, so it's roughly 10 years of data, and we see an underperformance of 45% pretty consistently. So with the S&P 500, you somewhat kept pace with money printing. Had you bought a large basket of stocks in Europe, you would have done worse. So you're getting all of that price volatility in stocks, and still, relatively speaking, you're not gaining more purchasing power, at least relative to the monetary expansion. Of course, relative to official inflation numbers, we do gain a little bit, but that's the problem, right? Official inflation numbers measure things like consumer goods, and consumer goods over time are deflationary in nature, as in we get technological progress, it's easier and easier over time to produce, for example, that TV. But once you look at things that can't be produced that easily, that are limited in supply, those kind of things will grow on average by 6.5%, by the rate at which money is expanding, at least that's in the US. And other currencies, of course, aren't much better, and other stock markets aren't either, right? This is again the Euro Stoxx 50 relative to the S&P 500. Here's the Euro Stoxx 50 relative to monetary expansion. I have a look at this. This is the Japanese index relative to the S&P 500. Since 2016 to today, the Nikkei lost against the S&P 500 by 35%. Again, this is already adjusted for the currency fluctuations. Have a look at this. This is Hong Kong. This is the Hang Seng index relative to the S&P 500. This starts in 1986, an underperformance of 68%. So what do we take away from this? We take away from this that it's very, very hard to beat monetary expansion just by buying stocks. On average, if you are in the US stock market, you might be able to somewhat keep pace. If you're in any other stock market, it's very unlikely that over the long term you're going to outperform. On top of that, we've got the problem that profits are very much concentrated, both for companies but also for stocks. In other words, if you buy a smartphone, for example, you want to buy the best one, right? You're not just buying an average smartphone. So a lot of demand comes to a few winners. That means most stocks tend to underperform. So you've got your stock market index, you've got, say, 100 stocks, and then most of those stocks, say 80 of the 100, do actually worse than the index, and the other 20, they push up the over index. So if you just randomly pick a stock, then you're very likely going to underperform. If you pick, however, among the winners, then of course you will outperform massively. And so let me show you what I mean in a very concrete way. Let's look at the constituents of the S&P 500. And let's just randomly pick something, right? I'm scrolling through this and I'm not looking at the screen. I'm just simply scrolling randomly and stopping somewhere. And let's take this one here. That's Regency Centers, ticker symbol REG. Here is REG relative to the S&P 500. Surprise, surprise, it underperformed like most stocks do. Let's do this again, scroll a bit around, take this one. United Airlines Holdings, UAL. UAL divided by the S&P 500 gives us this chart. Surprise, surprise, another stock that underperforms 70% this time. And so here's the problem, right? If you try to stock pick and you take something like, let's say, Revity, ticker symbol RVTY, then chances are that you're doing not as well as the S&P 500. So what do we learn from this? The US stock market has a hard time keeping up with monetary printing. Other stock markets even underperform more. Within the US stock market, only a few stocks outperform. So picking a few stocks in different industries and trying to outperform the S&P 500 this way is unlikely going to cut it. You're unlikely going to beat monetary expansion. You're also unlikely to beat the S&P 500 itself. That's why so many people buy simply just S&P 500 index funds. Now there is a silver lining here, and this is how I approach this topic. Have a look at this chart. Isn't this nice? Wouldn't you buy this? This is the Nasdaq divided by the S&P 500. And yes, we had our .com bubble and our subsequent crash, but over the long term, technology stocks tend to outperform other stocks. Here's the Nasdaq relative to US M2. So again, relative to the money supply, and the Nasdaq does beat the money printer. So this is where all the money is. It's in technology stocks. It's in high risk investments. So I can simply just buy QQQ. So that's the Nasdaq 100 ETF, low cost. Alternatively, if you know a lot about technology and you're following the trends very closely, you can of course also try to pick the winners. But again, it's a few winners that take most of the profits. That's true for the S&P 500. That's also true for the Nasdaq. And it probably doesn't take that much rocket science to guesstimate what those outperformers are, right? There's Apple, there's Nvidia, there's Microsoft, there's Amazon. Let's have a look at those stocks relative to the Nasdaq. Here's Nvidia relative to the Nasdaq. And the Nasdaq itself is already outperforming US M2. This is an outperformance here versus the Nasdaq of 23,000%. Again, profits are very concentrated. The winner takes most. Here is Microsoft relative to the Nasdaq. Here the outperformance is 3,500% roughly. Here is Amazon relative to the Nasdaq, an outperformance of 11,000%. And here's Apple, not that constant of an outperformance, right? We had our drama in between, but still more than 800% outperformance versus the Nasdaq since 1985. So we've got two choices over here. Either we write technology as a whole and we buy the Nasdaq 100 ETF, and maybe we buy some Bitcoin and we stay away from all those average stocks because again, the average stock underperforms the index. Alternatively, you try to concentrate even on the few winners. You try to find those few winners, which probably isn't even that tough. But of course, there is idiosyncratic risk to this, right? If you bought Tesla recently, then you're not that happy probably. Warren Buffett said, stay in your circle of competence, and I very much agree with this. Most stocks underperform the average, and even the stock market as a whole underperforms money printing, at least for most stock markets, maybe not for the US. If it's your first time here, feel free to subscribe. I publish videos regularly. Like what we very much appreciate as well. It helps the channel grow. This channel also has a free Telegram. Feel free to join us. Link is down below.